Hi, and welcome back to Channel 11 News. I'm Ken Shinoda, your host. This is Wednesday, October 26th, and I have Dr. Lindsey Piegza with me. And we're here to talk about the economy, inflation, growth, recession, is it here? And of course, what is the Federal Reserve up to? So Lindsey, thanks so much for joining us. We're really excited to have you on.
Thank you for having me. Appreciate the opportunity.
Why don't we just jump right into it with, the elephant in the room this year has been inflation. And at DoubleLine, we were kind of early to the non-transitory call, but I don't think we even thought that we'd see headline CPI get all the way up to 9%, and Fed fund expectations get up to 5% here. So what are your thoughts on inflation? We do think goods inflation is going to come down, but the employment market seems to be what the Fed is a little worried about. They just can't seem to get that unemployment number up, and that's one of the things that's driving the continued wage pressures out there. What are your thoughts?
Well, I think to your point, we have seen some relief in core goods prices, which is a welcome step in the right direction. However, supply chain disruptions are still very much in place. And I'm not entirely confident that we will see a sustainable downward trend in goods costs, particularly as much of the developing world is still imposing very stringent safety protocols in terms of responses to COVID. And of course, China's zero COVID policy is still very much in play. So that's a big wild card for inflation on the supply side, which is going to make it very difficult for the Fed to control inflation. Another concern that I have comes from the housing component. Now, housing prices have come down from peak levels, but on a national basis, at least according to S&P Case-Shiller index data, home prices are still up about 15%. And while housing is one of the, or arguably the most interest rate sensitive sector of the economy, we are beginning this downturn from a multi-year deficit in terms of housing supply. So the simplistic notion that borrowing costs go up, the housing market collapses, well, that's assuming we're beginning from a point of equilibrium. So there certainly is room for additional downward momentum in home prices. I want to be clear about that. But I also think there's ample structural support to keep prices in positive territory. This is a very different housing market than 07, 08. And so this, again, is going to complicate that inflation picture for the Fed. We're also seeing a similar shortage in terms of rental units. And some cities, yes, are beginning to see at least some softening, but others are still seeing 20, 30% rental renewal prices. So that, again, the inflation composition is very difficult and continues to surprise to the upside, as several Fed officials have said. And then again, adding in that final piece, as you mentioned, it's all about the labor market. This is one of the biggest components and one of the biggest frustrations for the Fed. Right now, we have over 10 million vacancies in the labor market. So labor demand is far outpacing labor supply, meaning it's not a lack of available positions or a lack of job opportunities out in the marketplace. No, it's a lack of able and willing bodies to come back into the labor market and fill those vacancies. So as a result, businesses at this point are doing everything they can to try to entice workers to either join or stay in a position of employment. Now, some are offering less traditional incentives. They're offering better healthcare services. They're offering daycare services, particularly for the younger generation. They're offering more social events, happy hours, pizza parties on Fridays, anything to try to make that job more enticing. But most businesses are resorting to that more traditional component, meaning higher wages. And we continue to see average hourly earnings up near 5% on an annual basis. And this, again, is going to create ongoing stickiness in terms of inflation, complicating the longer term trajectory for the Fed to rein in those price pressures. So this is a long way of saying that we do view inflation as stubbornly elevated for quite some time going forward.
And what do you think about the growth picture? The hope is that we cause an economic slowdown, and that should depress demand, and that should maybe help bring some components of inflation down. I totally agree with you about the housing market. By way of background, I don't think I told you, but I'm a mortgage investor, so housing is very on top of mind, and we totally agree that the lack of inventory should be supportive, but of course, some of these high-flying metros should take a step back. But recession is basically on CNBC or Bloomberg News or Yahoo News on a daily basis. Everyone almost agrees that one will happen. We had those 2 negative GDP prints, but if you look at Atlanta GDP now coming in, looks like it's going to come in positive for the third quarter. I mean, where do you sit as far as the outlook for growth?
Well, I do think that Q3 will likely be positive. We've seen some temporary supports, particularly to the consumer, but I hesitate to read too much into that as a starting point for momentum. It's very likely that while we do see that pop in activity back into positive territory for the third quarter, this will also likely be the only positive quarter of growth for some time, as we continue to see the Fed raise rates and essentially force the US economy into a prolonged period of a downturn. Now, will we technically see a recession? We'll have to wait for the NBER to determine that. When we look at historical cycles, the committee has been hesitant to declare a technical recession without job destruction, meaningful job destruction. And again, we just talked about the relative strength of the labor market. But that being said, I do think this debate is largely academic and completely inconsequential for the average American. Whether we're in a downturn, a recession, or as Alan Greenspan once said, not a recession, it's a cumulative unwinding of economic activity. But regardless of what we call it, hardship is hardship for the average American business struggling to tread water as we continue to feel this mounting pressure from elevated costs. And I would just add that while I think it's increasingly clear that we can check the box for every sector of the economy in terms of recessionary conditions, while that isn't necessarily the case for the labor market right now, we are beginning to see cracks in the labor market. Now, month to month, job creation is very positive, although the momentum is beginning to slow. The labor market at 3.5% is a near 5-decade low, but this is also reflecting 2 different trends. We're putting Americans back to work, but we're also seeing that precipitous decline in the unemployment rate, or we have seen that precipitous decline, reflecting the fact that millions of Americans are sitting on the sideline. And if you're not actively participating in terms of seeking employment, you're no longer counted as unemployed. So it's very easy to get that unemployment rate down to 0 if nobody's looking for work. And also keep in mind that we destroyed 22 million jobs with the COVID shutdown. And only as of July have we recaptured all of those 22 million jobs. So much of the job growth that we've been talking about has really been job replacement, just getting us back to where we were. So again, when we look at these different components of the economy clearly showing momentum, and yes, the labor market does appear to be the silver lining at present, I think we're already seeing some red flags in terms of weakness in the labor market that will likely, again, perpetuate the likelihood that we fall into recession or further into recession. But technically, we'll have to wait for the NBER to give us that start date of recessionary conditions.
Yeah, and it's a good point on the unemployment number. One of the things we had been looking at and talking about relative to the job market was that you had kind of a demographic wave, if you go back about a decade, of baby boomers that are exiting the workforce. Maybe that was sped up with people worried about COVID. And then also something I don't think many people are talking about is immigration numbers are down pretty big too since Trump. And do you think that, people talk about secular stagnation and, as population ages, they spend less. It just doesn't seem to necessarily be happening here. At least maybe that's a European and Japanese phenomenon of less spending, but it seems like there's plenty of spending going on from the boomers, even as they hit retirement. and maybe that's where we're not going to see that type of secular stagnation in the U.S. Do you have any thoughts on that?
Well, I do think that spending has slowed, certainly from not only that double-digit pace that we saw coming out of the recession, but even from the near 8% level that we saw last year, we're now down to just about 2%. So when we look at this from a broader perspective, spending across all Americans, we certainly have lost significant momentum. But to your point, there was also a tremendous amount of savings, not only during COVID, but leading up to COVID, that has provided a sizable amount of cushion for particularly the older generation. So these dropouts from the labor force may be a permanent structural loss as we move forward. Not to mention the lack of participation from some of the younger generations, as well as working families, particularly working mothers. So we are seeing somewhat of a structural change in terms of the labor force. But as far as getting to a position of secular stagnation, this implies a long-term, very low level of growth. And I think this is going to be predominantly determined by whether or not the Fed has the resolve to stay the course for reining in price pressures or reinstating price stability. If along the pathway to higher interest rates, the Fed loses its resolve or gets cold feet and begins to signal to the marketplace that it's nearing that terminal rate before inflation is under control, I think that leads us into a position of stagflation, where we're going to see elevated prices, but we're going to be at stubbornly low levels of growth. So here you get that stagnation scenario of growth, but it's going to be coupled with elevated prices. And that makes me increasingly concerned because that scenario is going to be very difficult for the Fed to use traditional monetary policy metrics to get us back anywhere near potential. So I think the stagflation scenario, as opposed to secular stagnation, is the bigger concern from my perspective.
And I guess on that note, what do you think about the Fed? Do you think they're going to stay the course? I mean, just very recently, I would say in the last week or two, it seems like there's been a little bit of change in narrative, at least in the looking at the bond market rallying a little bit, stocks, moving higher. There was that article in the Journal about, maybe they're going to pause towards the end of the year, beginning of next year. I mean, what's your view on what they're going to do?
I think given inflation is still at a 4-decade high and woefully underperforming the Fed's expected level of improvement in terms of price pressures, there's still quite a ways to go before the Fed can drop that mission achieved flag here or mission successful. The majority of Fed officials do anticipate reaching near 4.5% by the end of the year and slightly higher at about 4.75% sometime next year. However, what we've also seen is that the committee has consistently revised up their expectations with each summary of economic projections, or SEP, released on a quarterly basis. Yeah. And we do expect that again in December. So should inflation remain sticky at these stubbornly elevated levels, we would expect the Fed to not only reiterate their commitment to reinstating price stability, but also revise higher their expectations for rates come 2023. So resetting market expectations, which to your point have begun to maybe price in a little bit of a pivot. I do think from a terminal standpoint that we will eventually reach a rate closer to 6%, at which point, depending on the nature of inflation, the Fed may be forced to hold at these elevated levels for some time. I know 6% seems extremely high, but remember, the market has been behind inflation for quite some time. And the Fed also has been playing catch up. So right now, the Fed is telling us they're likely to push rates close to 5%. But inflation hasn't shown any meaningful improvement. So why should we anticipate the Fed stop now when they've told us reinstating price stability is their primary objective?
Everybody was in shock when Citigroup came out with their, I think it was either 5 or 7 hikes in March.
Right,
and people laughed at them like, 7 hikes, it's never going to happen. And here we are. I mean, it seems for sure they're headed to 5. I mean, do you have a view on long-term Treasury yields then? If they take Fed funds to 6, you would think the whole yield curve would parallel shift up. There'll probably be some inversion, but that would take the 10-year up towards 5%, I would think, at least.
Well, I certainly think the short end will follow along with the Fed as it continues to hike. So talking about the 2-year rate around 590 if we're pushing up to 6%. But the long end of the curve will continue to struggle to keep up with the Fed as policy is intentionally forcing us, as we talked earlier, into or further into recession. So even as the Fed pushes above 5% and nearing that 6% level, as we think, the 10-year is likely to be 50 basis points, maybe more below the Fed. So keeping that inversion up and down the term structure, not only through the end of the year, but likely through most of 2023, if not beyond. So I think it's going to be a very difficult, arguably ugly environment in terms of yields.
So what do you think? What do you think it takes for them to back off? Slowing growth isn't going to be enough for them. They're going to really stay resolved and wait for that, core PCE number to come down.
Well, remember that the chairman has been clear that not only is it expected to see a downturn, but it's necessary to see a prolonged period of pain in the economy in order to reinstate price stability. So I think the Fed would actually be pleased is maybe the wrong word, but I think that a downturn would be indicative of the conditions that the Fed is aiming for to get price stability back in line. But no, to your point, a quarter of negative growth here and there. We've already had 6 months of negative activity at the start of the year. This is not enough to deter the Fed. We have to see that price level come back down meaningfully in the direction of the 2% target. And I don't see that occurring until well into 2023, but likely 2024. The Fed has been more optimistic in terms of their inflation forecast, but they've also fallen well short in terms of reality. So again, reflecting the idea that the Fed consistently revises their expectations, and given where inflation is right now, I do think the Fed is going to be forced to take rates even higher than they've already told us that they're willing to do.
So given that view, I guess it's hard to be bearish on the dollar. Or do you remain pretty positive on the dollar relative to, other central banks not being as aggressive as we are here, even though in the UK you've got inflation higher than the US, right?
Absolutely. I do think that the Federal Reserve is the most hawkish, the most aggressive, and the most clear in their pathway to reinstate price stability. Now, we have seen the BOE also step in and say, look, we want to rein in inflation, yet at the first sign of market volatility, they were also willing to step in and provide that central bank put. The Fed has been very vocal that they are not going to step in and stabilize markets, barring some complete deterioration of functionality. But volatility aside, the Fed is focused on just getting prices under control. And with the labor market at a 5-decade low in terms of tightness, there really is no justification for the Fed to change course, which will continue to put upward pressure on the dollar. Now, of course, what does that mean for emerging markets? Well, higher input costs, higher borrowing costs. This is certainly going to have a contagion effect. And we've heard from the IMF come out and almost with unprecedented finger wagging at the Federal Reserve, reminding them that they do have implications for the global economy. Again, Chair Powell and company have been very clear that they're not the central bank of the world, and they are the central bank of the US. They're focused on the domestic economy. Right now, they're not concerned about the domestic labor market, but they are concerned about reinstating domestic price stability.
Yeah, we thought it was odd too when they came out with that statement as well about telling the Fed what to do.
Right.
So, how the strong dollar is pretty bad for emerging markets. Do you think there's going to be continued problems there? I mean, you're already starting to see some countries on the verge of debt-related issues and defaults. I mean, is that something that investors should be worried about? Is that a reason to kind of stay out of emerging market equities and debt right now?
I think if investors are taking a shorter term view, absolutely, that's a risk that we should be considering. At the same time, I do think that we don't want to throw the baby out with the bathwater, and there are some investment opportunities. I'll certainly leave that to individual advisors to pinpoint those. But I would say, broadly speaking, again, not throwing the baby out with the bathwater, there are some opportunities in the emerging market space. But yes, broadly speaking, there will be a contagion effect. There will be some defaults, and there is a rising risk of a global recession, with the developing world taking the likely brunt of that downturn, or that pain being felt across the globe. So it's absolutely a risk that needs to be taken into account. But again, I'll leave that to individual advisors and individual risk tolerance levels to be addressed on a more case by case basis.
Sure. And going back to the UK, I just thought it was really fascinating because it seemed like the bond vigilantes were finally back and finally won. And I was on the road last week talking to investors, and I was joking earlier in the week how trust could be gone in a month or two, and lo and behold, she was gone at the end of the week. But it just seemed like the bond market revolted and said, hey, guess what? Deficits matter. Debt to GDP matters. You can't cut taxes and increase spending, and we're not going to put up with that. And I just the risk to me, and I don't think the likelihood is that high, but there is a risk that that kind of mentality eventually spreads to the rest of developed markets. I mean, who's next? Italy? The U.S. debt to GDP levels are pretty high too. So do you think that's a risk that people should be thinking about, investors should be thinking about, is that kind of contagion of that fear that we saw in the UK only a few weeks ago?
Well, I think the bigger takeaway is the idea that monetary policy and fiscal policy need to be aligned if we're going to get the economy, be that the US economy or the global economy, back on track towards potential growth. And so when you have monetary policy desperately trying to reduce liquidity, rein in the money supply, slow consumption, essentially result in demand destruction, if you will. And then you have fiscal policy pushing in the opposite direction. Well, that doesn't work. That's going to create additional barriers and conflict in terms of the end results for the economy. And that's exactly what we saw investors responding to in terms of the Trust administration's proposals. Now, we do have a very important election coming up in November, and we could see a similar result here in the US. Now, politics aside, let's look at this just from primary proposals. If we do see power shift towards the Democrats, there has been a number of spending initiatives proposed, which could then gain enough momentum to come to fruition. And again, expansionary fiscal policy, very much at odds with what we're seeing from the Federal Reserve. Now, on the flip side, if we do see power shift towards the Republicans, there have also been some spending initiatives. I'm not suggesting that either party at this point is the party of fiscal responsibility, but what we're likely to see if power shifts to Republicans is gridlock. And that at least reduces the likelihood of expansionary fiscal policy, which would allow monetary policy to have a better control over the market and have a better opportunity to rein in inflation. So at this point, again, politics aside, I do think that gridlock is going to be the optimal situation for the US in terms of allowing policy officials from the Federal Reserve to do what they need to do to rein in inflation and avoid a scenario like we saw occur over in the UK.
So based on what I've been hearing from you, it seems like you don't believe that there's going to be a Fed put this time around, even if we go into a recession.
Well,
right?
I think at this point, the put is more likely to come from the federal government. We've already seen now $6 trillion in terms of spending to combat the impact of earlier policies and really attempt to prop up individuals, households, businesses. And this has been widespread support. Not only did we see a moratorium on rents, a moratorium on student debt payments, we saw direct checks going out to individuals and businesses. We saw additional checks as a result of the enhanced child tax credits, not to mention all the state and local stimulus that was put out into the economy. And now, $6 trillion later, we see more than a dozen states or large cities implementing another round of stimulus to constituents ahead of November elections, to constituents that are reporting a position of hardship, remember, shouldering those rising prices at the grocery store and at the pump, or those reporting a position of unemployment. So when we start to see the economy falter, when we start to see increased volatility in terms of markets, this time around, it's less likely that the Fed steps in with that unprecedented support. And I think a lot of the focus is going to be on the federal government, with an increased willingness, particularly in this administration, to provide additional support to a slowing economy.
That doesn't sound like it's good for inflation either.
No, unfortunately, it's not. I mean, think about it. Inflation in the US was essentially higher than anywhere else in the world coming out of the COVID recession, because not only did we have the supply side pressures of inflation that everyone else in the developed world, arguably the world, is contending with, but we also had the demand side pressures as well, as $6 trillion flooded into the economy, fueling price growth, fueling wage growth, and creating that wage price spiral where prices go up, consumers demand higher wages, then businesses charge higher prices, consumers demand higher wages, et cetera, et cetera. So in the US, it's going to be increasingly difficult for the Fed to get inflation under control, even if they can raise rates high enough to 5-6%, whatever it is, which will tap down consumption, tap down investment, slow the economy, and result in more benign demand side price pressures. Remember, we still have the supply side to contend with, and the Fed raising rates won't change China's zero COVID policy. It can't force resolution in terms of Russia and Ukraine, and the Fed certainly can't print more ships or more widgets. So I think right now, not only are we starting from a significantly more elevated position from inflation because of both the demand and supply side, but because of that complicated composition of inflation, even if the Fed is able to get the demand side under control, we're still going to see lingering price pressures as a result of the supply side variable.
Yeah, I don't know how much you follow our CIO, Jeffrey Gundlach, but he would agree with you on the money, the handing out of money. He said, we did it once and we set a precedence, and it's going to happen again. And it's a big concern of his. In that scenario, I mean, the deficit's going to continue to skyrocket. I mean, at what point do deficits matter here in the US? Do you have a long-term view on that? I mean, his view is that that's going to cause the demise of the dollar inevitably, is that we go into a recession, we send out the money again, the deficit skyrockets, and eventually people start losing faith in the dollar.
Well, I do think that that's a reasonable scenario, but we also have to look at it on a relative basis. And we weren't the only ones during COVID to be shelling out trillions of dollars. And we certainly aren't the only ones that are seeing rapidly rising debt levels relative to GDP. So while the nominal number in terms of debt is certainly frightening, keeping us up at night, on a relative basis, we still are the prettiest girl in the ugly girl contest. And so that gives me some hope that we will have enough time to put fiscal responsibility back at the top of the list of priority and get our fiscal books in order without losing significant ground on the dollar. That being said, that implies a number of different dominoes lining up. And one of the things we also have to consider that's increasingly concerning to me about the debt level is the servicing of the debt. Because remember, we had half as much debt about a decade ago, but we had the same amount of debt payment, the same cost to service the debt on an annual basis. And that's because of the level of interest rates. But we're no longer at zero interest rates. So as the Fed continues to raise, again, be that 5-6%, maybe higher, the cost of servicing even the existing level of debt, let's forget about adding on new levels of debt, is going to continue to rise. Right now, we're talking about, let's say 350, maybe 400 billion in terms of annual debt servicing. Well, factor in a 6% Fed funds rate, and now we're talking about nearly $1 trillion to service the debt by the end of the next decade, meaning by 2030. So this is a very rapidly concerning component in terms of stability, not only for the dollar, but the broader US economy. Because the only way to rein in these types of debt levels is a massive amount of spending cuts, which neither party seems to be willing to address at this point, or you see tax increases. And at this point, with tax levels already at arguably an elevated level, and we're already seeing a disincentive for workers to participate in the labor force, if we continue to load on mounting barriers from a tax perspective, I fear that this will create even more of an incentive for workers to remain on the sideline. Because at some point you become a minority partner with the federal government, depending on where you are up and down the ladder scale. And again, this is just going to compound that disincentive for workers to remain on the sideline, or the incentive, excuse me, for workers to remain on the sideline. So the level of debt has a number of different factors in terms of potential contagion to undermining more robust growth in the US economy.
We'll have to deal with it when we get there, I suppose. I guess lastly, we got your view on the dollar, your view on rates. I would say you're probably one of the more hawkish economists that I've read and talked to on that front. Do you think we're ever going back to zero interest rate policy and QE, or is that something of the past, given your view on more elevated inflation on a go-forward basis?
Well, first off, I like to think of myself as one of the more realistic economists, as opposed to just being hawkish. Again, taking a realistic assessment of where prices are. But to your question, will we ever go back to zero rates? Probably. Probably in the next downturn. If you look at a historical chart of Fed funds, we see nothing but a downward trajectory in terms of the lower bound and the renewed peak as we emerge from weakness. So the next time around, should the economy begin to organically decline and inflation is under control, I think there would be a lot of incentive, a lot of motivation for the Fed to continue to lower rates back down to these zero levels, which from a psychological standpoint, the market has arguably come to expect during a downturn. A more traditional downturn. Right now, we're seeing a forced downturn as a result of the Fed trying to rein in inflation. But again, going forward, if we did see that more traditional cycle of weakness, I think the market would absolutely expect and pressure the Fed to bring rates down to zero levels or at least very low levels in terms of policy.
All right. Well, thank you so much for joining us. A lot of great insight and leaving our viewers and investors out there something to think about as we see this bond rally today, maybe a chance to lighten up if we go a little bit lower in rates here. So thanks again, Lindsey, and it was a pleasure to have you on.
Thank you so much for having me. It was a pleasure talking with you.
Thanks, Lindsey.